We've experienced further weakness in stock markets this week. It certainly has been a roller coaster ride. Two key issues continue to weigh on sentiment at the moment. Most importantly, Greece and what is going to happen over the course of the next few weeks there, and also the speech from Ben Bernanke in the US, talking about the current US economy and that growth is slowing there, and some thoughts around that. And both of those issues have continued to weigh on sentiment. It's meant that money's come off the table, risk has been reduced, and stock markets have generally been under some pressure. If we take a look at the FTSE 100 here, now this chart really is a year-to-date chart, takes us back to the start of the year, some optimism at the beginning part of the year, the earthquake in Japan, which temporarily sent markets down to a support level, but a quick rally. But it's really been since April that the markets have begun to continue this slide back down to levels that have been sort of last seen at the time of the earthquake. Where we deal first of all with the Greek situation, we've seen this week the vote which has approved the new administration within the country. That, to be honest, was the easy part, and yet that vote was quite close. The hard part comes next week. We do have the vote on Tuesday for the Austerity Budget. This budget is in effect going to be sort of conditional for Greece to receive the money that is required initially to repay the bonds that are required in July and August, and really to put into place a second bailout package that can only really be put in place if Greece brings in these new financial plans. Now, I think where financial markets have sort of wavered this week, at the beginning of the week it was a feeling that the second bailout will take place, has to take place. But I do sense that the editorial comment, investor mood is turning. It's turning to some extent that this is certainly not a given that this austerity budget will be approved in the Parliament next week. And then where do we go? Because it then opens up a whole raft of potentially very negative sequences to be potentially spread across Europe. And that's the fear that is threatening markets at the moment. And it's why we're seeing this sort of very sharp drop in equity prices during the course of this week. Ultimately, this is going to come down, I sense, to common sense. If they cannot put in place a reasonable plan for restoration of economic growth in Greece, if they are going to carry on as they are, then this money will be wasted. And clearly, at the moment, no one wants to do the wrong thing at this stage, even if it softens the blow that inevitably will come. I think the key test in equities will be the banking sector. Banks do have plenty of exposure to Greece. Here in the UK, the exposure is rumoured to be around 12 to 14 billion pounds. It's not an insurmountable amount of money, but clearly on weakened balance sheets, it's still a big sum. The biggest concern is French and German banks. Their exposure is quite a bit larger. If a default were to happen, what impact would this have on the CDS market, the insurance market, to protect bondholders against default? And of course, what contagion would then spread? Would it spread to Ireland? Would it spread to Portugal? And ultimately, the big worry is, of course, Spain. Whilst it's accepted that the ECB's balance sheet could broadly accept default on its Greek bonds and the loss of value there, they certainly would require a much bigger balance sheet to be able to absorb any problems further down the track if Portugal and Ireland were to fall into the same situation. So clearly it's a worry, but my sense is that this is going to come to a head fairly quickly. Next week is going to be quite volatile, but it will come to a head, I think, quite quickly. The other factor which this does, or the other asset class that it does influence, is the currency. The euro here against the dollar has had a poorer week. It has weakened off in the sense of anticipation of impending events. And you can see that against the US dollar there has been some softness. That's despite the fact that the US dollar itself is not necessarily the strongest currency, and that's coming off the back of comments that, as I say, were seen by or heard from the Fed this week that US growth is slower than anticipated, inflation is higher than anticipated, unemployment is frustratingly slow in terms of repair. And so these are all issues which are starting to downgrade economic growth forecasts for the biggest economy in the world. This is the S&P index. It has a very similar pattern to its chart in terms of rolling off against the market from that sort of March-April high back down to the low areas tested last seen around the time of the Japanese earthquake. The only thing that really one could sort of glean the positives out of all of this is that corporate earnings have held up very well, and from July the 11th we do hear from US companies reporting their second quarter results. My sense is that if we're trying to look through some of the current problems and looking forward to areas of more positive news, from July the 11th we should start to see corporate earnings coming through from the US that should remind us all that despite the problems that are being seen around the world, corporate earnings are holding up, and so we look forward to that day. Just one small glitch to all of that is that if any company is going to warn on profits or see a slowdown, the capital goods sector tends to be a very early indicator of slowing demand. This is a stock in the UK called Charter that supplies into many of those economically sensitive industries. They had a profit warning this week. You can see there a very sharp drop in its share price. The question, of course, is this an exceptional situation, or are we getting the first signs of slowdown beginning to impact on corporate earnings? So if corporate earnings start to slow up, analyst forecasts too high, then I'm afraid that's another particular shoe to drop. So July the 11th onwards, US corporate reports are going to be very eagerly anticipated.